The Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edun, has introduced the Accelerated Stabilization and Advancement Plan, ASAP, aimed at tackling key economic challenges. Let's look at the inflation reduction angle, in the plan. Joining us now is Dr. Adesola Simoni, Senior Analyst, Financial Derivatives Company, joining us via Zoom. Great to have you on the show.
Thank you for having me, Ladi.
So we're seeing plans there to suspend import levies on food for 6 months. That's to ease inflation. We're seeing food inflation at over 40% at this time. How do you see this move by the government or the plan?
On one hand, okay, let's say it's positive, right? It's positive because the import levy is adds to the cost of some of these commodities. And previously, we've seen, since last year, we've seen the efforts by the government have not yielded much fruits, and so this is a welcome development. The removal of, or this planned suspension of levies, particularly on staples, on fertilizers, I think that is positive. I think it will help, reduce the landing cost of these commodities and kind of reduce the pressure on prices. It would also kind of help to boost our domestic production of some of these commodities, which is positive.
Right, and definitely we see all the positives, but are there any risk here at this point? Because we see food inflation over 40%, but is there any angle to this that could pose some kind of risk? Because we know we're trying to support local production and all of that. Is that going to impact us negatively?
I think at the moment the risks are muted. I think in terms of local production, facilitating local production, the removal of levies on fertilizer, I think that is positive. We know what is happening in Ukraine and Russia, and that is directly affecting the import cost of fertilizer. So removing the levy, I think that helps with the cost of fertilizer. Also removing the levies on things like grain for feed for poultry, I think that is supportive. Removing the levy on grains, on flour, which are like the staples, I think that kind of helps to reduce some of reduce the landing cost of some of these really, really important commodities, and that can really help to reduce price pressures in the domestic economy.
All right, and the proposed suspension period will be for about 6 months. Looking at the situation of things right now, is 6 months enough, or should we be looking at maybe 2 years? 40%, over 40% food inflation.
Obviously, 6 months is a short period, but I think this is kind of like an initial phase, and then the government may extend it if needs be. But for the initial 6 months, I think it is positive. Also, remember, this is also revenue for the government, right? The government is kind of forfeiting this revenue, and it's important to note that the government, if you look at the budget performance of this year, it is quite lower than expected, particularly because of lower oil exports, lower oil production. If you look at the budget benchmark, oil production is put at 1.8 million barrels a day. By the moment, we are producing around 1.2, 1.3 million barrels per day. So there's that shortfall. So by foregoing some of these levies, this import levy for 6 months, the government is kind of trading off some of its revenue in order to reduce the hardship or help to improve the quality, the purchasing power, the quality of life of Nigerians.
Right, and definitely I hope government revenue is not impacted, so much, with this plan. But let's look at the global oil market this time. We're seeing prices close to our benchmark. That's oil price benchmark for the 2024 budget, at this time, $78. Big drop yesterday we saw in the oil market, but now we're seeing a rebound. There you have it, $78. That's the oil benchmark for the 2024 budget, with an oil production assumption of 1.7 million barrels per day. So are we in trouble here with these prices, these oil prices?
It's difficult to say at the moment because there are many factors driving oil prices globally. And like I said, Nigeria's oil revenue is more elastic to production rather than price. And so what we need to be more concerned about is what we can control really, which is our production. I mentioned earlier, reports from OPEC shows that Nigeria's production is around 1.3 million barrels per day for the month of April, which is quite low compared to our budget benchmark of around 1.78 million barrels per day. And if you look at the global oil space, the factors that drive it are pretty much out of our hands, right? Look at, we are hearing news about there are now expectations that the US would cut their benchmark interest rates around either July or September, which is positive, which the market has viewed as positive in that it will stimulate economic activity and also stimulate oil demand growth. Already we are seeing Canada has led the pace in cutting their benchmark interest rate, and the expectations that many other high-income countries would follow suit. And globally, I think this is positive because it would kind of stimulate economic activity globally, and it will stimulate oil demand.
Right, and investors globally are just bracing for when the U.S. Fed is going to cut, interest rates in 2024. But let's just imagine that wake up one day and we see that the U.S. U.S. Fed has cut interest rates for the first time. What's going to happen to all these markets?
I think first that will be positive because it kind of signals to the global economy that there's a change in the monetary policy stance. We are moving away from tightening cycle now to a loosening cycle. And if the US cuts, I think many other high-income countries as well are going to cut their interest rate, and then that will globally reduce the cost of funds globally. So it will also stimulate investments, it will stimulate business activity, it will stimulate economic activity, and I think it's positive all around.
Right, it'd be great to see how that plays out, definitely. But who knows? It might not even happen, this year. But Canada is already leading the pack. We'll see if the U.S. will, at some point this year, cut interest rates. But let's look at the Naira. We're seeing weakness yesterday in the official window. What would you say is driving sentiment at this time?
I think at the end of the day, it's still the market is quite volatile at the moment. We are contending with issues of lower supply, despite the bumper interest rates and despite the high yields in the fixed income markets. We have a 365-day treasury bill around 25%. I think for foreign investors, I think there's still a little bit of anxiety on their path, despite what we are seeing, despite the hike in the sharp increase in monetary policy rates. We are not seeing a huge inflow of foreign portfolio investments. We are seeing trickles here and there. There's still also heavy demand on the market. I think once we begin to see globally a change in the monetary policy stance globally, I think that would help increase inflows of foreign capital into the economy, and I think that would help. Also, we are seeing the central banks still intervene in the market. Like I mentioned, in May, we saw the central bank intervene around 575 million US dollars in the market in May, which is the highest this year, and this was higher than the interventions in March and April combined, which were around 340 million. And so I think the biggest problem is just thin supply, and I think that the central bank is doing everything that they can to improve supply and attract investments into the economy. But I think foreign portfolio investments are still a little bit anxious about the economy, particularly about repatriating their profits or their profits after their investments.
All right, Dr. Desola Sobonyi, always great to have your perspective. So much to unpack there. We'll see how the week closes for the Naira, definitely. Thank you so much for coming on.
Thank you for having me.
All right, we'll take a break now. When we come back, what other sources are available for the federal government? Talking about revenue. That's our next conversation. Do stay with us.